Welcome to our comprehensive tutorial on central banks. In this video, we'll explore what central banks are, their primary functions, and how they impact the economy with real-world data and examples. A central bank is an institution that manages a state's currency, money supply, and interest rates. They are pivotal in maintaining economic stability and fostering monetary policy. One of the primary functions of central banks is controlling inflation. Let's take a closer look at how they do this using monetary policy instruments. Central banks use tools such as interest rates, open market operations, and reserve requirements to influence inflation. For example, during high inflation, they might increase interest rates to reduce spending and borrowing. Let's look at a real-life example. The Federal Reserve, the central bank of the United States. During the 2008 financial crisis, the Federal Reserve implemented a series of measures to stabilize the economy, including quantitative easing and lowering interest rates. Another critical function of central banks is managing the nation's foreign reserves. They maintain reserves in various currencies and gold to manage the exchange rate and ensure financial stability. Central banks also play a crucial role in ensuring financial stability by acting as a lender of last resort to banks in times of financial distress. To keep your understanding grounded, let's address some common questions about central banks. Question: how do central banks influence interest rates? Answer: central banks set the benchmark rates that influence the cost of borrowing and saving across the economy. They can influence short-term interest rates directly and affect long-term rates indirectly through monetary policy measures. Question: what is the impact of central bank policies on the average consumer? Answer: central bank policies can affect everything from mortgage rates to savings rates, employment levels, and overall economic growth, ultimately influencing the purchasing power and financial well-being of consumers. Let's look at some statistical data to see the typical impact on unemployment rates when central banks adjust monetary policies. Lastly, let's discuss how central banks interact with various global financial institutions and the importance of international coordination, especially during financial crises. For example, during the 2008 financial crisis, central banks of various countries coordinated efforts to provide liquidity and stabilize the global financial system. This coordinated effort was crucial in preventing a deeper and more prolonged global recession. In this video, we delved into the world of central banks, their roles, and the impact they have on the economy. Understanding these concepts is crucial for anyone interested in finance or economics.